This region around the Great Lakes has been called the heartland. When it comes to agriculture, there's hardly an area in the world that compares.
Everybody, just hold on. I don't know what we're going to have here.
There's a lot of self-proclaimed geniuses out there that know the national yield, but they're all wrong.
Managed money, piling in.
Double digits higher.
So at this point, we're in kind of uncharted territory.
There's a lot of money on the sidelines.
So that was a crazy one.
That's what brings the viewers back. That a boy.
Good morning, everybody. It's Wednesday, August 12th, and this is the AgYield War Room. I'm Dan Dempsey, and I'll be moderating today's session. As always, if you get any questions or comments, please feel free to drop us a line in the chat area. I'll be sure to get to it during the show. Overnight markets here, December corn up 2 3/4 at 463 1/4. September soybeans are up 3 1/4 at 1154 3/4. And September Chicago wheat was up 15 at 645 1/4. This morning, we had an export sales announcement, 244,000 metric tons of soybeans sold to China. That was for 26. Overnight, quite a bit of action going on over in Russia. Ukraine bombed 2 key ports. I think that certainly got into the wheat market here overnight. And guys, we got report day, 11 o'clock Central here. So we're going to get a big data dump. A lot to talk about here. Dustin, why don't you kick us off with a few thoughts, and then we'll throw around the room.
Yeah, thanks, Dan. Yeah, it's a big report day, as we've seen the last couple of years, last year in particular. I think the biggest change that you really want to think about is last year they added 1 billion bushels of supply in this report, and it really caught everyone off guard by a long shot. It's surprising, but we were coming from a lower level, and maybe that's why. It was only a 13-cent drop last year, and that was basically the contract low for December 25 corn. So that's one of those cases where even if you know the number ahead of time, it might not be traded properly. It's hard to know how the market's going to perform either way. The things I'm thinking about are what's a little different this year. We do have a 2 billion bushel carry in, and it seems evident that that's the case. That's going to be a much larger, supply buffer to whatever the number is that we're going to see for production. And we're seeing that in spreads a bit. Flat price is higher though to start, and we are working and operating under the belief of record demand. The fact that most people are expecting a yield cut, in the average estimate, that's probably tilts me to be just a slightly bearish going into the report. There's odds are that that they could keep it unchanged, or maybe even higher. So that's probably my biggest concern as a risk is when I look at the average balance sheet for growers. 430, 420 futures would be just enough where we're not expecting a lot of insurance payments, not knowing if we're going to get a farm bill payment yet. And looking from the mid 460s at average yields or above average yields, any unsold acre has a lot of risk down to that level. And contract low was 425. So being that it is August, we have a 2 billion bushel carry in projection. I think that the risk, my concern would be if we have a surprise higher print on yield, what's it going to look like as we go into September 1st notice day and all these bushels on DP or on basis only need to move, and we get that tin can harvest in August? That would be my concern. So I hope that's not the case. I hope that the market just keeps going higher and keeps giving producers the opportunity to get a good price. But just kind of from my perspective, what my fear would be is that the risk is lower, I think, for the average producer from this price point.
Very good. Ben, what's on your mind today with the big report coming?
Yeah, just to kind of play off of what Dustin said there too. Try to think through things that would potentially be sustainable. And at this time of the year, a customer brought up a good point to me. He's like, well, this is normally when we bottom out. Yeah, but we're coming off a pretty big rally off of drought fears. But a sustainable rally at this point would have to really be a shocker in order to entice end users to be nervous and manage money to want to get long at a time of the year where we're looking at a lot of supply coming to market in the next what, 8 weeks, 9 weeks. So I think even on a higher print, it's going to be hard to sustain something really robust to the upside. You know, I think there's reasons to look around and be concerned. And, you know, we look at the matrix and how many times we go to the place that might be the worst possible spot. So, and that would, you know, call it 20, call it 35 to 20, 20 to 35, whatever that may be. But it certainly puts you in a tough spot when you're sitting there. So I don't know what they can give us that would be really, really supportive. You know, there's not a big short here to expose. Managed money is actually long. So I don't think a grower is going to start bailing out of hedges on August 15th because most of them should be above the market from here. So I don't know who the next buyer is unless the global buyer gets really, really spooked by Russia, Ukraine. But we've known that now for what, going on 3 weeks or 4 years. Pick it. So.
Justin, what's on your mind? What are your thoughts?
I'll be a little counter to those points, I guess. You know, I think a lot of this stuff's factored in both sides. You know, I think it's not a surprise. You know, I think after last year's shock on the report, after yields came in higher and higher and higher, and we gained all this supply, I think there's certainly plenty of chatter that that's a risk. You know, that yields go higher and we break into first notice day. I think that's why we're not at 490 now. We're at 460, and we've taken back half that rally. So I think the market's actually in pretty good balance, personally, for what we know today. Now, if the yield comes in 188, 189, and we just have way too much corn, we're going to go lower, you know, in my opinion. You know, as far as like, you know, the big carry-in, I mean, we've got SEP Dees has been holding at almost full storage for better part of a month now. You know, the spreads are wide, you know, so I mean, the market is trading that we are going to have plenty of supply in the near term, and that maybe out forward looks more exciting. So I don't think that there's a right now, like kind of bullish or bearish, that there's, you know, there's no one talking about it. As I said yesterday, I think the market's balanced, meaning that there's a decent amount of bulls and bears. You know, I don't feel the market's leading hard one way or the other right now, personally. You know, to Ben's point, like wheat, you know, we've known these scares, you know, are they poo-pooing it until there's actually the point where, you know, big buyers come and they have to cover those needs? You know, we know that European coarse grains got whacked with a really bad drought. You know, so there are some problem areas where, you know, corn, I could look out forward and see really robust, you know, spring program or even winter program for corn in this country once we work through, you know, kind of the remainder of South American supplies, where corn's kind of the game in town again. So I actually think out forward, I'm actually kind of slightly friendly, the corn market, you know, after first notice day, but I think first notice day has been talked a lot. So it's kind of one of those where I actually hope it really breaks into first notice day, and I'm not sure I'm going to get that chance. Because I think if it really fell apart, you would build something, I think, a pretty good bull case going forward from lower levels in here. So if you got into those low fours, I'm not sure the market's going to give you the opportunity, but if it did, I think it'd be a good one for buyers. And beans, I think, has the most risk. Again, I've said this a few times, but you know, we're going to, I think, probably keep trying to buy beans going into, you know, China's going to try to fulfill commitments. And there's obviously currently a meeting scheduled for, is it September 24th, maybe?
Yep.
So it surprised me that we see, you know, continue to see, you know, bean demand on breaks. But if the forecast is really good, we're going to have one of the wetter August finishes we've had for the beans in years. So I personally think a surprise to the upside on yields will be beans. Now, maybe there's enough demand that doesn't matter. But I do think as far as a yield shocker to the upside, that's the one I think has the biggest potential with the current forecast.
When you talk about balance too, Justin, I mean, a fun position in the upper 130s for both corn and beans. I mean, nothing, you know, anything that catches your eye.
Yeah, I mean, it's certainly a bigger proportion for beans. You know, I mean, we've seen corn longs that are pushing close to 500,000. So
right.
130,000 contracts anymore isn't really that big, in my opinion, for the crop size that we have. And even 2 billion bushel carryout isn't nearly as big for the crop size that we have. You know, stocks to use ratio wise, like, 10 years ago, 2 billion bushels was a lot more than it is now. You know, when we're using that much more a month. So yeah, I think we've traded a lot of these things. And if you look at the charts, right, I think they kind of say that we overdid it, going into June 1st notice day. We overdid it again, probably upside when we were worried about a drought when we were back in the 490s. And now we're kind of right back in the middle of that range, I think rightfully so. So it's an uncomfortable spot, right? Because you're like, okay, to Dustin's point, do I want to go sell my corn because I've got 30 cents of risk on the downside? Right? That's tough. So it's just a kind of an uncomfortable position. So I think a lot of what, we've been trying to do is collect premium, do things that kind of bridge those gaps and not lock yourself in too hard one way or the other.
Yeah, and I think that's a good thing to note is that we don't have to be so black and white in marketing. Even just a little bit of marketing, like studies show, 25 to 33% of production. When you start to tranche all these extra payments that come in, like ECAP or bridge, which usually come in lower price environments, right? They're coming in because revenues are low to negative. And farm bill revenues is the strongest farm bill of my career right now. And, that's another round of payments that's going to come in low revenue environments. You add on top of that, just the stabilization of a quarter to a third, that could be the difference of being profitable or not for the year. And it doesn't mean that, that's why I said I still would rather see a rally. I'd rather see that money come from actual bushel revenue than I would from, government payments. But, I think that's when I look at balance sheets, I still worry probably most in the mid to lower fours. 350 oddly it's actually a better outcome even for the unsold producer than $4 on average because of all these tranches of payments right now.
Yeah,
Yep.
Very good. Good point. Well, that report will be out at 11 o'clock Central. We'll take a look at the numbers and then we'll be out with a video shortly thereafter. Ryland, let's move real quick over to livestock. It was a pretty quiet session overall for cattle. Hog market a little bit softer, but August kind of inched a little bit higher as it comes into expiration here. So I guess why don't you share a few thoughts with us this morning?
Yeah. Yeah, definitely mixed action kind of in both places, really. I mean, on the cattle side, we're still holding that 10-day moving average, still kind of trending higher, all focused still on the beef market. But beef was just a little bit lower yesterday. At Choice down 11 cents and Select down 104. So, overall, just not too crazy of price action there. But I think just leading into Labor Day, that market still is going to stay pretty hot and still trend to the higher side at this point. I mean, this is kind of some of the best demand time frame we see going in to the Labor Day holiday. So I think all eyes are going to be on the beef and see if cash market stays pretty steady here. Did see some light trade at 235 in the north, but I think everybody's going to be kind of focusing on the south, and we can see at least steady to firm trade there. But obviously market's just kind of in a holding pattern for right now. And on the hog side of things, just kind of ran into some near-term resistance. I mean, just you had both cash and cutout a little bit weaker yesterday. So it just looked to kind of back everything off for the most part. Just feels like the market's pretty cautious here. We did add about 4,600 new positions on an open interest report this overnight. So it looks like, overall, I think we're seeing a little bit of new shorts here. I mean, typically the trend right now is lower, pretty much between now and the end of the year. And a lot of that's already baked into the board. So I think there is a little bit of wait and see mentality with just how exactly this is going to perform here. But carcass is down 33, belly's down 20. And once again, cash was down 36 cents at 96.32. So, I think you've got just a lot baked into the market right now. And at this point, there just isn't a lot of hope that we're really going to see a big pop here into Labor Day. So we'll see what happens. But I think there's just most of the optimism is kind of gone here on the hog side.
Very good. Appreciate the update there, Rye. Again, one more time, USDA report out at 11 o'clock Central. About 11:15, we'll put out a premium video for our subscribers there. Be reactions to the report. Also, tomorrow's Thursday. We'll get weekly export sales, 7:30 Central. We'll take a look at those. Visit about that in the War Room. If you'd like access to the premium content, link is in the description. But check out the War Room report. It'll open up those videos, reactions to USDA reports, deeper dive into everything we talk about daily here on the War Room. Also, a portion of those subscription fees will go directly to support the AgYield NextGen Foundation, which of course puts on our national scholarship competition for ag students. It's a great program there. Check it out. If you got any questions, give us a call. Get a quick rundown here. We just opened. We got December corn up 2 3/4 at 463.5 is the last. September beans are up 3 at 1154.5. And September Chicago wheat's up 15 1/4 at 645.5. Appreciate everybody that tunes in on a daily basis. If you wouldn't mind, throw us a like and certainly subscribe. We're doing this every day that the markets are open on X, Facebook Live, and YouTube Live at 8:15 Central Time. Appreciate the thoughts and comments here this morning, guys. It was a good show. Hope everybody has a great day, and we'll talk to you again tomorrow.
The War Room is presented by AgYield, a risk management partner of American grain farmers for over 50 years. Looking for more in-depth analysis? Check out the War Room Report. Our team's knowledge and expertise delivered straight to your inbox every weekday. Each report delivers key market-moving headlines, critical weather updates, USDA report breakdowns, and exclusive video content. All for $50 a month. And most importantly, 10% of every subscription will go directly to support the AgYield NextGen Foundation, a nonprofit investing in agricultural education and the future of farming. To sign up for the War Room Report, check out the link in the description or learn more at agyield.com.
Hey guys, Jack here. Be sure to support the show by hitting the like button, leaving us a comment, and subscribing to the channel for all the latest updates. Thanks for watching. We'll see you next time.